Yes. Thank you. Do you like this more?
All right, so reminder, once again, do your course evaluations. That's important to me and the future generation of students, so please do those. Today's music recommendation, sadly, I have no more concerts to recommend that I'm going to this year. Last two concerts, Friday and Saturday, so which I talked about last week. I hope you guys will manage to get to one of those if you can. But two of my favorite bands are coming this spring. One is called Jukebox the Ghost. They're a really fun pop band. And they're my recommendation for today. So you should check them out when you come by in the spring. Okay, what we're gonna do today is finish chapter 24 on discussion of corporate taxation. And then we'll start chapter 25 on discussion of tax reform. So we've covered a number of topics in corporate taxation, but we haven't covered one of the most important topics, which is how taxation affects the financing of investing, or the field of corporate finance. Once again, you can take dozens of courses on this. In course 15, I'll do it in about 25 minutes. But basically, this is kind of an interesting area of how you think about how corporations make the key decisions they need to finance their investments. Okay, so suppose, take a look at figure 24.5. So suppose a firm needs $10 to buy a machine. And that machine every year will deliver a marginal product of $1. Deliver goods worth $1. Okay. Now, as we talked about last time, one way the firm can finance that machine is out of retained earnings. They can take the money they have saved and buy the machine. Let's ignore that for now. Let's imagine the firm doesn't have retained earnings. They need to finance that purchase. They need to get the $10 now to buy the machine. Well, there's two ways they can do that. One is they could borrow through corporate bonds. That's the upper branch of our diagram. Or they can issue stock. Okay? If they borrow through corporate bonds, then once they earn that money, okay, that money is paid to bondholders. Now when they earn the dollar, that return is paid out to bondholders. That's the rate of interest. They earn the dollar, that's paid out to the bondholders. Okay, but interest is tax deductible. It's an expense. So it's not at all subject to corporate taxation. So if I earn $1 from this machine and I pay it out to my bondholders in interest payments, there's no corporate tax. It's fully deductible. Okay. Then it goes to bondholders, and the bondholders, when they get it, pay their own personal rate of tax on it. Let's say the tax rate on interest income, which we'll call TAO intern. Okay. So what happens? I earn the $1. Nothing happens at the corporate level, but when the bondholders get it, they pay tax. Alternatively, I could raise that money by selling $10 worth of stock. Now when I $10 worth of stock, the $1 that comes back to pay out to stockholders, that will get taxed at the corporate level. Okay, so I'll pay corporate taxes on that. Then that's the middle branch. That's in TOS C, I pay corporate taxes. Then there's two ways I can get that money out to the stockholders. One is I can pay them a dividend, on which they'll additionally pay taxes. So the middle branch in the final panel shows that if I earn the money and then pay it out as dividend, I pay both corporate taxes. I pay corporate taxes and my dividend always pay dividend tax. Alternatively, I could use it to increase the value of my company by $1. That would generate a capital gain for my stockholders. So they would then, I wouldn't increase my $1 by $1 if I went minus cost C, because I pay corporate taxes. That higher value, when the stockholders realize it, they pay capital gains of cost C. So ultimately, if I get money from people, there's three ways I can get. If I get money from people to invest, there's three ways I can get it back into their hands. Okay, I can pay it as interest, I can pay it as dividends, or I can pay it in the form of capital gain by increasing the value of my company. Okay. Now remember, in terms of these tax rates, remember, let's say that traditionally TAW int and TAW div were the same. Traditionally, you get the same tax rate on your interest income as your dividend income. But TAW CG has always been lower. That's been said for 7 glorious years since the late 1980s. It's always been lower. Plus, as we know, capital gains tax rates are even lower than that because all the various loopholes like step up and mix and debt, etc. So as we think about this diagram, remember, let's say TAW int is the same as TAW div, but TAW CG is lower. Now, given that, this diagram raises two mysteries about corporate finance. Think about companies that are financing themselves both by debt and equity, borrowing and selling stock, and their financing, and with their equity, they're both paying dividends and capital gains. What are the two mysteries? Just look at this diagram. What are the two mysteries that raises? We see firms using all these options. Why does that look not tax minimizing? What could a firm's, yeah. Right, well, and let's look at the middle range. Which option looks better on the middle range? Yeah, right? They don't pay the corporate tax. So the first question is, why do companies have equity? If I have equity, I have to then, if I have an equity payment, I then have to have corporate tax. If I just borrow the money, there's no corporate tax. So there's a gain for everyone. The government doesn't take a bite out of the middle. Okay? Now you might say, well, gee, if TAW intersection I relative to TAW CG, maybe it cancels out TAW C. Let's ignore that for a minute. Let's imagine that let's just say overall that the individual tax, that basically it's worse to pay corporate tax than not to pay corporate tax, even though you get different tax rates on the income in the end. So the first mystery is, why aren't firms all debt? Given that debt is tax preferred. What's the second mystery? Given what we know about the size of these tax rates. You look at this table, you're running a firm. What other decisions do you think you should make? Yeah.
Why do they pay dividends?
Why do they pay dividends? We know TAW CG is below TAW div. Why pay dividends? So this leaves us with two mysteries. Why not be all debt, and why pay dividends? And those two mysteries sort of animate much of the field of corporate finance. So those are the two mysteries I want to talk about now. The why not all debt mystery is basically about there's a number of different ways to look at it, but it all boils down to one thing. You have to make interest payments. You don't have to pay dividends. If you don't make your interest payments, you go bankrupt. If you don't pay your dividends or capital gains, your stock's worth less, but your company's still around. You don't go bankrupt. The bottom line is debt comes to the degree of inflexibility that stock doesn't have. Let me put it this way. Imagine I offered you two grading schemes in this course. One was, I will grade you on the average of all your problem sets. The other was, I will give you a grade based on the highest of your problem sets, but if you ever fail one, you fail the class. Okay? You'd probably be more worried about the second one, because the first one, maybe your average go up and down, but at least you're safe. The second one's like, well, screw up once I fail the class. That's why people don't like debt. You miss one payment, it's done. You're gone, you're bankrupt. There's much less flexibility. So managers basically like equity. They don't like debt, because debt holds their feet to the fire constantly. They constantly have to make those payments. Equity holds their feet to the fire somewhat. You get bad press if you don't pay your dividend or whatever, but you don't go bankrupt. Okay? So basically, what that means is A, that managers prefer equity to debt. So there's an agency reason for that. But B, the price you pay to finance your investment also depends on equity versus debt. And what I'll show you now is that basically the more of your company that's debt, the higher interest rate the bank is going to charge you. To see that, let's go to the example of table 24.1. So imagine a company that's worth $6 million. Okay? It's got 1 million of debt and 5 million of equity. Every period it pays $500,000 in interest payments. The interest rate's 10%. So every period it pays $500K in interest payments on its I'm sorry, it paid not 500K in interest payments, because it's only got 500K, 10% interest rate pays $500K in interest payments. Okay. And that its earnings, it has $600K in earnings. So it takes the other $100K and pays a dividend. Let's forget capital gains for the minute. That makes it complicated. Okay. So every year the firm takes in 600,000. It pays 500,000 out to the debt holders in interest payments, the other 100,000 out to the equity holders. In dividends, each group gets a 10% rate of return. It's the capital markets at equilibrium. Okay, each group is getting a 10% rate of return. The equity holders are getting a 10% dividend. The bond holders are getting a 10% rate of interest. The difference, of course, being that the equity holders are getting less than 10%, right? Because the corporate tax is paid on that. So why don't they just get rid of those equity holders and go all debt? Well, now imagine that there's a project this firm could do. And imagine the project is the following prospects. 50% chance that it makes $3 million and a 50% chance that it loses $6 million. Now, as an owner of this firm, as a general owner of all this firm, you would not want the firm to take that bet. That is a negative expected value bet, negative expected value of minus $1.5 million. But let's think about this from the equity holders' perspective. What happens if they take this bet and they win? Well, they take this bet and they win. The entire $3 million goes to the equity holders. Because the debt holders just get their 500K each period no matter what. It's a fixed payment. So if they win the bet, the equity holders get all the upside, right? You pay your interest no matter what. So it's the people, the equity holders. So they get plus $3 million. What do they lose if you lose the bet? Well, if you lose the bet, the firm goes bankrupt. What does that cost the equity holders? Well, they lose their original $1 million and they lose the PDV of the $100,000 in dividend they would have gotten forever. At an interest rate of 10%, that's another $1 million. So they're out $2 million. So for them, it's a good bet, right? If they win, they get all the $3 million. If they lose, they're only out $2 million, the $1 million in equity and the $1 million in PDV of dividend payments. The key point is who makes the decision for firms? It's the equity holders. The equity holders, the shareholders, are the bosses of the firm. So in this situation, those very bosses will have incentive to take risky, low expected value bets or even negative expected value bets. Okay. Yeah.
If the firm goes bankrupt, who's the one who takes responsibility for it?
I mean, it goes into bankruptcy court and then the assets get divvied up. But let's assume this is just sort of a.
So wouldn't this be the same as like if I just took out a loan, I just I just went out to like Las Vegas and just like bet on everything.
Yeah, I mean, basically this would be the same thing. I mean, and basically this is, I mean, it's an investment opportunity, but you can just call it a gamble. You call it crypto, whatever you want. Okay, it's just a speculation. The point is that speculation you wouldn't want a firm to make, but the equity holders here do want the firm to make it. Meanwhile, the debt holders, what happens to them if they make this bet? Well, if the bet hits, they win nothing because there's no upside to debt. You just get your interest payment. But if it loses, they're out the $5 million in the company and the PDV of the $500,000 of interest payments. They're out $10 million. So the debt holders are like, this is a terrible bet. Okay. So basically the bottom line is now let's say we flip this. Let's say we flip this and equity holders had $5 million and debt holders only had $1 million. Well, in that case, the equity holders wouldn't want to take the bet either. Because with $5 million in equity, if the company goes bankrupt, they lose $10 million, just like the debt holders did. So they're like, forget it. We don't want any part of this. The bottom line is, as the equity share goes down, the consequence for risk taking gets smaller. If $1 is equity and $5.999 million is debt, then go to Vegas. Take the biggest gamble you can. Most you lose $1 and you get all the upside. Okay. So the bottom line is, so given that, now pretend you're a bank and two firms come to you, the first firm and the second firm. Which one are you more eager to loan to? Which firm? You're a bank. Some of you will be bankers. What are you going to do? It's two firms. Yeah.
The second one.
Yeah, the second one. Much more eager to the second one because the first one's going to take stupid risks with your money. So what that means is you're going to charge a higher interest rate to loan to the first firm. What that means is the tax benefit of being all debt is offset by the higher interest rate you pay as your debt equity ratio goes up. So one factor that's not in figure 24.5 is the fact that the more as your debt burden gets higher, you're going to pay a higher interest rate because firms know that they're bearing more and more of the risk.
So that's one reason why, that's why firms might not be all debt. Okay? Which is that basically it's going to be harder to raise money. You're going to have to pay more when you do. Now, firms, of course, aren't all equity either, because there is a tax advantage to that. And there's other reasons too. Obviously, in the whole field of corporate finance, tax is one piece of a larger corporate financing scheme, but this is sort of how it works in the margin. Yeah.
Like some companies that the person who runs the company are the same as like the shareholders or the equity holders. In that case, does this like
Shareholders are equity holders.
yeah, but they're not the one making direct decisions sometimes.
Well, yeah, no. So this comes back to the agency problem. So the managers don't like that either, because that makes them have to pass every week's problem set. So the managers by themselves, they don't like that either. So the tax advantage is offset both by managers' preferences and by banks' preferences. Okay. Okay, so that's the first mystery. The second mystery is why pay dividends? I mean, after all else equal, the capital gains tax rate is way less than dividends tax rate. Why not just give more rewards in capital gains? Indeed, dividends have fallen substantially over time, but there's still billions and billions of dollars dividends paid every year. And the best answer there is that basically, essentially, it's a form of agency theory, which is that basically we don't want managers to be sitting on that much money because we think they'll waste it. The idea is if you don't pay dividends, the money's going to sit there. And if it sits there, managers can get up to bad antics. There's more money, basically, it's a more tempting cookie jar. So for example, if you take in 2002, they took the 25 largest longstanding dividend payers. Those folks currently had cash reserves of 160 billion. They found that if those firms had never paid dividends, they'd be sitting on $2 trillion in cash. And I think many firm owners believe that the more cash you put in front of a manager, the more likely it takes do wasteful things and take stupid bets. So it's essentially the agency problem is you would think of paying dividends as an inefficiency you're willing to put up with to make sure the managers don't have too much money that they can do stupid things with. Is sort of the best theory. And indeed, there's a very interesting study which showed that dividends are that basically dividends. What did the Chetty study show? That basically when you cut dividend taxes, the effects are bigger where the agency problem is bigger. Yeah.
Is dividends just you like the shareholders cashing out some of their shares?
Dividends just you get a check every quarter for X cents per share you're on.
Like where does money come from? Just from the stock rising? No,
the money comes from the company. It has the money it earns and it pays it out to you.
Okay.
It sends you a check every quarter based on the money it's earned. All right. So that's the answer to the other mystery. Now this raises, yeah.
What about stock buybacks?
Okay, so stock buybacks are an interesting wrinkle that aren't in the textbook because they really weren't such a big deal till the post-Trump tax cuts. That's another way that you can that's another way you can get money out of managers' hands, is to say, look, essentially you have all this money. We don't want to pay it in dividends because that's inefficiently taxed. So we'll just essentially buy back our own stock. We'll essentially get the money out of the manager's hands by buying stock with it, and the stock will buy as our own. That's not you can buy someone else's stock too. Okay, they buy their own stock, and what that does is that bumps up your stock price, and it gets the money out of the manager's hands. But it isn't subject, but it does so the way it isn't subject to the dividend taxes. So the money, when you bump that stock price up, all your stockholders are happier because they're getting higher stock price, which taxes the tax preferred capital gains rate. Once again, this is another distortion caused by having a lower capital gains tax rate. If capital gains tax rate was the same as the dividend rate, there'd be no incentive to buy back. Just two different ways to get money out to people, to get your money out to your shareholders, right? You can bump up their stock price by buying back or send them a dividend. The reason like buybacks is because the tax rate on those is lower than the tax rate on dividends.
So for the company and the shareholders, it's like the best of both worlds.
In a sense, yeah. That's a good point. Okay, other questions? Yeah.
Okay, can you recap on the why dividends are inefficient?
Oh, dividends are inefficient because they're tax inefficient. Because if you look at figure 24.5, you pay a higher tax rate. TAW div is higher than TAW capital gains. So as a shareholder, I'd rather get the money in capital gains. All right, so that's corporate finance in a nutshell. Let's talk about what does this imply for dividend taxation, which is a hot topic. Dividend taxes were cut a lot in the Bush administration and continue to be much lower. Dividends until 2001 were almost always taxed in the form, capital gains have always been tax favored. But until 2001, dividends were basically taxed the same as interest payments. In 2001 was the first time we had started treating dividends more favorably, just like we do capital gains. And currently the dividend tax rate is much lower than the interest tax rate. So you pay less on dividend than you do on money in the bank. And the question is, why? Well, the answer is the theory of the Bush tax cut was it will promote investment. Because ultimately, the rate of return to investment is a function of all the taxes you pay. If you go back to our investment decisions from last lecture, basically, essentially your investment is a function of the taxes you pay. The taxes your entity pays. The more your shareholders are taxed, the less they're going to want you to invest money and make money. So the lower taxes should feed back to firms making bigger investment, right? Essentially, a tax on your shareholders is a tax on the firm's investment decisions. Think about if we had 100% tax on dividends. And you only pay dividends. Why would firms ever invest? And the return on investment would just get eaten up by the government. So the idea is as you lower the tax on dividends, you raise the return to investment for firms, just like lowering the tax on corporations, raise the return to investment on firms. That ultimately in a world where firms pay dividends, the effective tax rate isn't just about 1 minus tau c. It's also about 1 minus tau c times 1 minus tau div. So the more you lower the dividend tax rate, the more you promote investment, is the theory. The problem with that theory is it's incoherent given that we don't know why firms pay dividends in the first place. Okay, imagine the reason firms pay dividends is to get the money out of their managers' hands. Okay, that if you cut the dividend tax rate, you will cause more dividends to be paid, but it won't affect investment. They're not paying dividends because they want to invest the money. They're paying dividends because they just want to get the money in their manager's hands. So just raise dividends, but won't affect investment. And in fact, that's exactly what happened with the Bush dividend tax cuts. There's no evidence they actually raised investment. They just caused bigger dividends to be paid to shareholders. They cost more money to come out in the form of dividends, but there's no evidence they actually increased investment. Yeah.
Did you say again why they thought it would increase investment?
Oh, well, the reason they thought it increased investment is because basically they thought, well, the rate of return to an investment is marginal product of capital times this thing. So if you lower this, you raise the rate of return to an investment, so people will invest more. The answer is no. The answer is they just paid out more, they didn't invest anymore. Now this comes back to where we started the whole lecture, which is why tax corporations at all? Why don't you say, look, all the money made by corporations is ultimately paid out to people. Let's just tax people. Now the answer we had at the beginning of the class was, gee, what do you do about retained earnings? Well, the answer is you could just apportion them. You say, look, whatever the corporation makes, something called corporate tax integration. They have corporate tax integration is basically whatever you earn. If I'm a shareholder in a company, the company earns money, I get taxed on it. Doesn't matter how it gets paid out or whatever. If I own the company, I get taxed on it. Okay. And in theory, actually, that makes a lot of sense. It gets rid of this whole extra layer of corporate taxation. It just says, look, capitalists need to get taxed. We won't pay retained earnings because we'll tax the money as it comes in. And in theory, that's a great idea. In practice, it would create an enormous tax cut for the rich. Because right now, as the rich complain about, you're double taxed on your shareholding. As figure 24.5 shows, when you invest in companies, you're taxed twice. Once at the corporate level, once at the individual level. Integration would get rid of the double taxation. It should be one tax. So that's great. So it'd probably be more efficient and less equitable. So it's a standard equity efficiency trade-off in place. Yeah.
And if the complaint is that the rich get taxed less, can't you just do the thing, but just make all the levels a bit higher?
Exactly. So once again, if economists were king, which we should be, remember, Ours Impossibility theorem says the only way to have a purely consistent government is either to have single peak preferences or one ruler.
Oh.
Remember, no, seriously, if economists ran the world, probably would prefer corporate tax integration with higher top rates to account for it. Okay. And that would probably be a better system. But the problem is, the rich guys like the integration, not the higher rates. All right. Any questions about corporate taxation? So the way to work is basically every year, Gruber Co. would earn money. I'd have a bunch of owners. They'd say, you own 1% of Gruber Co. Gruber Co. made $1 million this year, so you've earned $1,000. You've earned $10,000. You're taxed on it. Sort of makes sense, right? Just kind of like, it's like you own a company, it made money, you get taxed on the money it made. Why fucking around with this corporate tax thing in the middle? And it sort of makes sense. It's just transitioning there would be very difficult. Now I'm making it way too simple because like, what do you about depreciation? I mean, there's a lot of complications in reality that there's a lot of other reasons why the corporate tax integration should be a mess. But probably most economists would favor moving to some system like that. It'd be a lot more transparent and efficient. It's just that it'd probably be less equitable realistically. Yeah.
When you cut the tax dividend, you said that
The tax on dividends.
the tax on dividends, something you cut that, your investment does not change.
Right.
There are more dividends than investment.
No, they just pay out more in dividends and invest less. If anything, there's less investment. That's the point I made. If anything, that would cause less investment. So basically, if you think that I was not clear on this, it's a great point. Let me go back. If the whole reason, imagine company makes a certain amount of money. And in a world where there was no agency problem, they wouldn't pay any of it out in dividends. They'd invest it all. But now forget buybacks for a second. They'd invest it all. Okay. But now there's an agency problem, so I have to send some out in dividends. So I invest some, send some out in dividends. Now imagine the tax on dividends goes down. Well, I'm going to send more out in dividends. Where's that going to come from? Less investment. So it actually is the opposite effect of the intended effect. So the sign is, the sign isn't even clear about what effect it had. In the world where dividends are paid out to solve the agency problem, a dividend tax cut causes less investment, not more investment. In a world where there's not an agency problem, it causes more investment. The evidence is zero. The evidence is they cancel roughly. That's a better way to explain it. Okay, questions about that? Yeah.
Wait, I'm still a little confused. Like, I just assumed that like how it works is that you invest, like you buy some shares and you just wait until like, what you want to sell. And then that's when you get the money. But like,
No, that's because you're like a new school investor.
Right.
Old school companies and a number of sort of non-tech companies, actually some tech companies do, mostly non-tech companies, still pay what's called a quarterly dividend. So if you're stock in a company, you get a check every quarter, which is certain cents per share you own. It's just a check they send you every quarter.
Is that in addition to the money you'll get at the end?
Exactly.
So just free money extra.
Well, presumably once they send to you, there's less money they're investing in making their share go up. So it's tax inefficient. You'd rather they didn't do it.
Okay.
Other than the agency problem.
Oh, so like by paying the dividends, they're kind of like lowering the share. And then
No, well, what you're lowering the money you have to invest.
yeah.
Think about investments being productive.
Right.
So that's another way to explain it. This is hard. I mean, this is why there's a whole course 15, right? I'm doing this in 25 minutes, now 30 minutes. Okay. But basically, think about the company has money. The most efficient thing to do from a tax perspective would be invest that, raising the company's price. The problem is the owners don't trust them. They think they're not going to invest it. They're just going to waste it. In that case, they'd rather have it. And that's what dividend does. Okay. Or stock buyback. Stock buybacks would seem to dominate dividends in that sense. The question is why in the world of stock buybacks we still do dividends. That's it. You have to take course 15 to figure that out. Okay. Yeah.
Why can't like the shareholders have any say in like the investment and like oversight on the?
Shareholders do. They have a board of directors that is supposed to keep an eye on it. It's just too hard. It's like my private jet example. It's just too hard to know. If there's so much nitty gritty managing a firm, you just don't have time. I mean, the board of directors, plus the board of directors, almost all old CEOs who made all their money off the agency problem and they don't want to solve it. So basically it's just, it's a bunch of guys getting paid a lot of money to sit around and be yes men for what the manager wants to do. Maybe I'm just bitter because I'm not on the board. Other questions? Okay, so now let's go on and talk about the last chapter, chapter 25. We'll do most of it today and we'll finish it up on Wednesday. Chapter 25 is sort of the catch-all chapter of kind of let's bring back everything we did in sort of chapters 18 through 23. We won't really talk about corporate taxation. And let's bring it back to think about fundamental tax reform. Here, the motivation, you guys remember Herman Cain? Herman Cain ran for president. Herman Cain's entire presidential platform was the 999 tax. The 999 tax, I'm going to get rid of all these stupid taxes we have in America. Tax your income at 9%, I'm gonna tax your consumption at 9%. I'm gonna tax your, I forget what the third one was. Your wages at 9, what was 999? It was income at 9. 9% corporate tax, 9% personal income tax, 9% sales tax, done. None of this fancy deductions, so much, all this various stuff. Make it easy. And in fact, he actually got a lot of support based on that idea. Indeed, there's a history in the last 50 years of candidates, basically their number one platforms have gotten simpler, easier taxes. Taxes have gotten too complicated. They've gotten too confusing. We need to just move to a simpler, flatter tax system. They're too progressive, etc. Step one, simple flat tax system. Okay, so really what I want to talk about in chapter 25 is how do you think about what we call fundamental tax reform? And as I said, the major example of fundamental tax reform in our nation's history was the Tax Reform Act of 1986. Before 1986, there were 15 tax brackets, ranging from 11 to 50%. There were enormous numbers of special tax treatments of things from capital gains, etc. The Tax Reform Act of 86 went from 15 tax brackets to 3. And it basically, Haig Simons did. It basically took everything and said, everything's income, we're taxing at 3 different tax rates. Okay, over time, we've basically undone the Tax Reform Act of 86. We're back to a very complicated multi-step tax system. We'll talk about why. So the question is, how do we think about the costs and benefits of a simpler, flatter tax system versus the sort of much more complicated and progressive tax system we have now? Okay. And what I want to do is I want to talk about 3 arguments for why we would want to move to a simpler, flatter tax system. So why fundamental tax reform? The first argument has to do with tax evasion. So far, we've talked about what might be called tax avoidance, paying charitable deductions instead of paying your wages, or getting health insurance instead of wages. Those are legal means of reducing your tax bill. Tax evasion is illegal means of reducing your tax bill. Not paying taxes that are owed. And there's some great examples in the book, of all sorts of tax fraud schemes. Probably, there's great examples, various rich guys not paying the taxes they owe. It's not just rich guys. When we put in Tax Act in 1986, before 1986, if you wanted to claim a dependent exemption, you wanted to take your kids off your taxes, you had to list their names. In 1986, you had to list their name and their social security number, and 6 million kids disappeared in America overnight, okay, because they didn't really exist. People were just cheating, claiming them on their taxes. So my favorite examples are from other countries. So one of my favorite examples is Greece. So in Greece, they try to tax home values, but it's very hard to measure home values. And they decided a big correlate of having a high home value is having a private pool. So they said you have to pay higher tax if you have a pool. Remember the window tax? This is the pool tax. Well, in the wealthy suburb of Kifisia, 324 residents reported they had a pool, whereas the right number was 17,000. So the president said, this is ridiculous. We're going to send helicopters out and see who has a pool. So it actually became a booming business in camo tops for pools, so people could hide their pools from the tax collector. Okay, so this is tax evasion. It's tax cheating. Yeah.
If you accidentally tax evasion, is that tax evasion?
Ignorance is no excuse for the law. If you tax evade, you tax evade. But it's an interesting question. This comes back to the Gary Becker theory of optimal punishment. We should just kill one drunk driver and everyone will stop drunk driving. You don't want to do that because the guy might not have realized he was driving drunk. You wouldn't want to kill the tax evader for the same reason. But it does lead to this question of how should we punish tax evasion, which comes to the larger question, what's the theory of tax evasion? And like any other theory in economics, we can put in a simple cost and benefit diagram. So look at figure 25.1. Okay, figure 25.1 talks about how people optimally decide how much to evade their taxes. On the x-axis is the amount by which you underreport your income. So as you go to the right, you're cheating more. On the y-axis is the costs and benefits of cheating. So for example, if you, the benefit of cheating is you save taxes. So the marginal benefit of cheating with a flat tax system is just the tax rate. So in this example, with a 50% tax rate, the benefit of evading taxes is 50%. It's a flat blue line. On the other hand, the cost of cheating is the odds of getting caught times the penalty you'll pay. And let's assume the more you cheat, the higher your odds go and the bigger penalty you pay. So that would say a rising marginal cost of cheating. So flat marginal benefit, which is you just save the money you save. And there's a rising marginal cost, which is the more you cheat, the more likely you are to get caught and bigger the fine will be. So that says there's an optimal level of cheating originally at point A. Point A says that given a 50% tax rate and that marginal cost schedule, you'll optimally cheat by amount E1. Okay? Just like any decision we can put in economics, marginal cost, marginal benefit framework. Okay? Now what this says, for example, is that it has various comparative statics predictors. For example, if you increase the penalties for cheating, that will lower cheating. So that's why if we kill the tax cheat, we'd have significantly less tax cheating. But we don't know if we do by accident, so I wouldn't want to do that. But the higher you make the penalties and the higher you make the probability of being caught, you shift the marginal cost curve up, there's less cheating. Okay? Likewise, if the tax rate goes up, there'll be more cheating. Because at any given cost, the marginal benefit of cheating is higher. Okay, with a tax rate of 0, there's no benefit to cheating. The tax rate of 100, you get enormous benefit. Okay, so basically what this says is that basically what will drive the amount of tax cheating is two things. One is how high the rates are, and two is what are the penalties. So what's the evidence on this? Well, first of all, there's a lot of cheating. So in the US, we think about 17% of the taxes owed are not paid. That amounts to about 3% of GDP, or about $630 billion a year. That's close, not quite the entire size of the deficit, but getting close to the entire size. In most years, that'd be bigger than the deficit. Okay, so it's a big amount. Generally, if you look at developed countries, their tax gaps, it's called the tax gap, are generally in the range of 10%. Okay, we're a little bit high. Developing countries have much bigger tax gaps. In Pakistan, we think it's 70%. In Greece, my favorite example, the tax gap is 90%. 10% of the taxes that are paid. Actually, it's interesting for those of you interested in history. The history is interesting. The theory is that's because Greece basically protested against the occupation by the Ottoman Empire by not paying their taxes, and it became like a brand of cultural, like a cultural brand was to not pay your taxes. That's how they screwed the Ottomans. When the Ottomans left, they kept not paying their taxes. Yeah.
So are their tax rates really high then, like nominally very high?
Well, there's a trade-off. Okay, so basically the question is, if people don't pay their taxes, what do you do about it? What's the trade-off? So basically, the bottom line is that an argument for lower taxes is that basically will lower cheating. That essentially, the other way to say it, you can raise your rates, that's going to make cheating worse. There's sort of a Laffer curve-like argument, which is that, now it's not necessarily the wrong side of the Laffer curve, but of all the various arguments we're going to have for lowering taxes, we're going to go through 3 here. One argument for lowering taxes, it'll lower cheating. So having a lower tax rate, you lower the marginal benefit of cheating, so cheating will fall. Yeah.
Also, is this why they had to get a bailout from Germany?
What's that?
Is this why they had to get a bailout from Germany?
There's lots of reasons. That's the whole course.
Okay.
There's lots of reasons. A lot of it's the Olympics, but we can come back to that. So basically, the bottom line is one argument for sort of a flatter, lower tax rate, besides all the Hague-Simons, this isn't anything about, our standard deadweight loss formula, is that basically with a lower, flatter tax rate, there'll be less cheating. Okay, so that's another argument. Now, of course, yeah.
How come this is because of like the tax rate being flat? Like, isn't it just because like if there's a lower tax rate, people will cheat less?
Yeah, it doesn't matter. It's flat. The point is a low. Oh, you're right. There's nothing to do with simplicity and flatness. It's just lower rates.
Sure, but I mean, if they charge lower taxes, then they won't actually get more money because there'll be less cheating. Right?
Well, it depends on what the elasticity is. If the elasticity is greater than 1, they might. They could be on the wrong side of the Laffer curve. It's not. But in principle, they could, but they'll just get less cheating. We're talking about sort of a set of arguments for lower tax rates, and this is one of them.
Sure.
Okay. So basically, now, of course, what determines whether you cheat is not just the tax rate and the penalty. There's lots of things that determine whether people cheat, and there's a lot of fun studies of that. So, for example, they basically, there's a study in Denmark where the co-authors actually ran an experiment where they randomly sent out letters to 40,000 taxpayers in Denmark saying they were going to be audited or checked. That basically what they found was that basically if you were threatened with an audit, you cheated less. And if your tax rate was higher, you cheated more. So it just sort of confirms this model. Okay. But there's some more interesting studies. So for example, there's one study in the US where they sent out letters to taxpayers warning. They first sent out letters to taxpayers saying, it's really a bad idea to cheat in your taxes. It hurts everybody, whatever. That did nothing. They then sent out letters that said, we will audit you. That lowered tax cheating. But this is what was interesting. It caused most people to report more income. It caused the rich to report less income. And the theory for why is that the rich view this as the opening bid in a negotiation. They said, we're going to report less income because we know you're going to audit us and ask for more money. So I'm going to start at a lower level so I have more room to pay you back. I don't know if that's true, but that was kind of a clever explanation. There's another interesting study where they actually found that if you audit, most people in America get their taxes done by a tax-paying professional. What they had all the people who went to a given tax-paying professional said if you audited more people seen by a given professional, then everyone else he treated's taxes got more honest as well. That the more you said to a given professional, I'm going to audit person A, then that same person B who was treated by the same professional, they reported more income as well. So all sorts of interesting side phenomenon there. Yeah.
So like if you go to a tax professional and like you say you don't really know anything about taxes and like
Right.
they end up doing something illegal, do you get
No,
punished?
it's on them. It's on them. I mean, ultimately, I don't know how the penalty structure works. It saved you money. You wouldn't get jail time or anything. I don't know. I think probably what would happen is you would owe back the tax part and they'd have to pay the penalty part, is my guess. But I don't know for sure. It's a good question. Okay, so basically there's all this fun stuff on taxes, but the most interesting part of tax enforcement is the political part. So in 1997, there was a giant hearing, set of hearings in Washington, September 1997. It was a hearing run by one of my least favorite politicians. We all know Mr. Roth, the head of the tax scamming Roth IRA, basically had a hearing which involved all this terrible testimony of people's lives were ruined by IRS hassling them. They had people, a New York priest talked about being hounded by the IRS to pay tax he didn't owe on a trust set up by a recently deceased mother to help the poor. Investigators found one case of a man who committed suicide after a protracted battle with the IRS over back taxes. People actually came with bags over their heads to testify because the IRS was making their life so miserable they didn't want to be identified. This was front page news, was horrible, and the reaction was quick. There was an enormous reduction in the size of the IRS enforcement. Basically, the IRS was shrunk by a third. The IRS, I'm sorry, is the Internal Revenue Service. They collect the tax in America. And in reaction to these hearings, the reaction was fierce and fast. The IRS was said, you're hassling taxpayers too much. We're going to cut what you do by a third. Okay? So two things have emerged since then. The first is every single one of these stories was a lie. Every single one of these stories, it turned out people were fraudulent tax evaders and the IRS had behaved exactly right. Indeed, in that year, not just those cases, but a watchdog group set up in 1998 investigated 830 complaints of harassment by IRS and found that every single one was justified going after tax cheats. So first of all, it's all a farce. Second of all, the reduction enforced by IRS has caused a massive increase in tax cheating. That basically from 1997 to 2000, the number of field examiners dropped by 2/3. The number of collection cases fell by a half, and the number of evasion cases pursued fell by 2/3. In 1977, 8% of corporations faced an audit. Today, 1% do. So if you cheat, there's a 1%, as a corporation, there's a 1% chance you'll get caught. Okay? Self-employed people who have the most scope for cheating. Remember, once again, if you're someone who's just a regular working Joe and you earn your money in a payroll, you can't cheat. It's reported right to the government to take the taxes out as you earn it. Okay? The cheating happens, people have other more flexible ways of getting compensated. So self-employed people are on that list. The audit rate for that group fell by in half. Indeed, the IRS has identified $30 billion of underpayments they could collect for $2 billion. That literally, given $2 billion, they could collect $30 billion of underpayments, and Congress wouldn't agree to fund it. So basically, this is just been a huge topic. And indeed, part of the Inflation Reduction Act, part of the funding for the spending Inflation Reduction Act came from actually increased investment enforcement by IRS. It's the first time since the mid-1990s that we've actually invested back into the IRS and actually invested in them collecting taxes. The best estimates are that if you just did sensible things like updating the IT infrastructure for the IRS, bringing audits up to a more sensible level, we could raise something like $100 billion a year in more taxes. And that's part of what they did in this recent bill. So basically, it's something you can think of the Inflation Reduction Act as paying for fighting climate change by catching tax cheats. It's not a bad trade. Yeah.
So the Republicans got all mad about the 87,000 IRS agents because they think that they're saying that they'll target middle class. Are they wrong?
They're absolutely wrong. That basically, essentially where all the money is the rich. So actually, there's a really interesting paper where this guy it was for one of the Scandinavian countries. They got data from the Panama Papers. Remember, the Panama Papers was an expose of where all the rich people held their money offshore, and they could actually look at where people held their money. I think they estimated for that Scandinavian country that by dollars, 99% of all tax evasion was done by the top 0.1% of people in dollar terms. So it's true, some middle class people do get audited. The truth is we probably shouldn't audit anyone who's not super rich. But once again, you want to middle class people somewhat, because middle class people cheat. I mean, if people cheat, they should get audited. So, but the truth is, most of the money will be collected from the richest Americans because that's where the dollars are and that's where the cheating opportunity is. Most middle class people have no option to cheat. Okay, and remember, cheating on your taxes is terrible along every dimension. I'm not making a moral statement. From a social welfare perspective, tax evasion is terrible along every dimension we talk about. It's terrible for efficiency because you will avoid their taxes. You have a lower tax base, which means a higher tax rate, which means deadweight loss goes up and tall squared. So end up with less efficient taxes. It's less vertically equitable because the rich cheat on their taxes more than the poor. It's less horizontally equitable because two people are identical, but one's dishonest, they pay lower taxes. So tax cheating is terrible from every social welfare perspective we've taken in this class. And so it's really great that finally we're able to step up and do something about it in this last bill. It's not enough, but at least it's a step in the right direction. Okay, questions about that?
How does the IRS audit?
It's a nightmare. I mean, it's a real pain. What they do is they come back and you're supposed, when you're grown up, remember you have to keep 7 years of all your papers that you pay your tax. They can come to me at any time and say, John Gruber, we want every receipt that your tax reporting is based on for the last 7 years. So every charitable gift, I have to have a receipt, stuff like that. It's a pain in the ass. I mean, it's really pretty tough. But the truth is, so there is some inefficiency associated with honest people like myself getting audited, but that's small relative to the benefits that are gained from actually cashing the tax cheats. And that's why you wouldn't want to audit that many middle-class people. Basically, the audit rate of people who have just wage income should be very, very low. The only way they could cheat is like misdeclaring their charity. But for people who where income is less wage income and more self-reported income, then the audit rate ought to go up. Yeah.
Wait, so if I go to Target and buy a bunch of Chips Ahoy, I get a receipt. Do I have to keep that receipt like for 7 years?
Wait, no, you don't take Chips Ahoy off your taxes.
They tax like my payment, right? Like sales.
No. They don't. No, not sales tax. This is income taxes.
Oh, okay.
This is income taxes. Don't worry about your Chips Ahoy. You're good. Okay. Okay. So that's one argument for why we want to at least lower taxes. Okay. It relates to a second argument for fundamental tax reform, which is the argument I started with, which is tax simplicity. Taxes have gotten unbelievably complicated. Take a look at figure 25.2. In 1940, the number of pages that came in the individual tax return were 2. In 2017, it was 217 pages. Came with just a regular Form 1040 individual tax reform. The IRS estimates that it takes about 16 hours for the typical individual to collect tax forms. And the estimated financial burden is about $260. Okay. So one study estimated that in the year 2000, taxpayers spent 3.2 billion hours and $18.8 billion filling out tax forms, which is basically the equivalent of 1.5 million extra IRS employees. Okay. So basically, we spend a lot of people hate taxes because they're a pain in the ass to do. Okay. Or you have to pay someone a lot of money to do it for you. So people don't like taxes. So basically what people have said for a long time is we need to make taxes simpler. And that's been a long time rallying cry, has been a simpler tax system. Yeah.
You might have answered this like in a previous class, but why do we have to do our taxes? Why can't the IRS tell us how much we owe?
I'm going to come to that. Okay. So basically, the idea is simplification is a sensible goal. I mean, it's hard to argue against people spending less time doing their taxes. Okay. But it's important to remember, as always, there's a trade-off, which is many of the other goals we have for optimal taxation make the tax system more complicated. For example, let's talk about taxing health insurance. Remember, I said there's a huge inefficiency in our US tax system, which is I'm taxed on my wages and not taxed on my health insurance. Well, if you tax my health insurance, that makes the tax system more complicated. My employer's got to report my health insurance, the IRS has to track it, et cetera. It makes the system less simple, but more efficient. So it's not, simplicity is not an easy, it's not costless to go to a more simple tax system. That basically it actually is something which has a trade-off. So simpler tax system makes a lot of sense. It would pay dividends in the sense that people would be less opposed to taxes, so there'd more support for government doing what it needs to do. But it might get in the way of accomplishing other goals the government wants to accomplish. Okay, you can actually see. You might say, well, how big a deal is? How big a pain? What is the sort of cost of filing taxes? How big is this cost? So it was a really cool study. Take a look at figure 25.3. This is a really neat study that was done. So with this study, look at the sort of panel A in 1980. What this study did is it said, let's look at whether people, remember when you file your taxes, you have a choice of taking the standard deduction or itemizing. Let me remind you from chapter 18. When you file your taxes, the standard deduction says that based on whether you're single or married, you get a certain amount of money off your taxes. Itemizing means you basically, if you give a certain amount to charity and your mortgage, et cetera, all the stuff that goes on Schedule B of your taxes, if that adds up to enough, you can take that much off your taxes. That's a better deal. Essentially, the idea is if your itemized total, which you have to compute and add up, is more than the standard deduction, you should itemize. If it's less, you shouldn't. What this graph shows is the share of taxpayers that itemized in 1980. What you see is nobody below 9903 itemized, because that was standard deduction. From that point, if you look starting about $2,000 past that, it falls. The series falls. It falls because basically the distribution of income gets thinner. There's fewer and fewer people in each income cell. These are essentially total itemized deduction cells. So there's fewer and fewer people with each amount of itemized deductions. It's a natural falling curve. But there's this weird part where it jumps up at first. And what's weird is you look at each panel of this diagram. Each of those panels is different years with different thresholds for itemization. In every year, it jumps up right at that threshold before it starts coming down. In other words, what it's saying is that starting about $2,000 after the threshold, fewer and fewer people itemize because there's fewer and fewer people would have big mortgages and stuff. But at first, there's a bunch of people who essentially should be itemizing who aren't. In other words, this curve should continue upwards till it hits the red line. Moving from the right to the left, that green line should keep going upwards till it's the red line, but it dips down right before the red line. Why is that? Well, that's because a bunch of people don't itemize because it's a pain in the ass. So essentially, we have what we call a missing mass. If you take that green line, which is a fairly clear exponential line, just continue it to the red line. So go from the left to the right, go continue the left to the red line. You'll see there's essentially a gap where it should hit the red line, but it hits it much below it. Well, that's a set of people who don't itemize because they don't want to do the work. And what this author says is that provides a revealed preference measure of how much people don't like itemizing. It's sort of a really clever way, much like I'm talking about revealed preference measures of value of life. There's a real preference measure of the cost of itemizing, and the cost seems to be about, on average, about $150. People are willing to forgo about $150 to avoid the hassle of filling out Schedule B, which is just one of many tax schedules. So it shows there's real consequences. People really don't like doing the work of doing taxes. Pretty clever study. Okay? So that's the second reason. The third reason for why people want sort of a simpler, flatter 1986 level tax reform is tax efficiency. And here, this is really an extension of what we covered in chapter 18. In chapter 20, I'm sorry. In chapter 20, we talked about how the deadweight loss from taxation is a function of the square of the tax rate and various elasticities. What the literature on tax efficiency in the last 30 years has said is it said what that's missing is that basically the elasticities themselves are a function of the tax system. Or in other words, let me put it a better way. Chapter 20, we said that the deadweight loss scratch what I just said. Here's a better way to say it. We said that the deadweight loss of taxation was basically taxing more elastic things had more deadweight loss. So we talked about the elasticity of labor supply, talked about the elasticity of savings, but we could have gone on and on. There's a million things we tax. In 1990, Martin Feldstein, a famous economist, said, you know what? We're thinking about this all wrong. All we care about is what is delta tax base, delta tax. Let's not worry about the elasticity of the labor supply and the elasticity of all this stuff. All we care about is the Laffer curve. All we care about is how does raising the tax lower the tax base? That's the one elasticity we care about, right? Because revenues are basically TAW times tax base. Okay, so the effect of raising the tax, dr dTAW, remember, is tax base plus TAW times d tax base dTAW. So this is the only elasticity we care about, is d tax base dTAW. Let's not mess around with these labor supply and savings elasticity stuff. Let's just ask, when you raise the tax, how much does the tax base go down? If that elasticity is greater than 1, we're on the wrong side of the Laffer curve. If it's less than 1, we're not. It was sort of a obvious, but sort of a shot across the bow to public finance. Okay, so basically the question is, why does the tax base change when the tax rate changes? And it turns out the tax base changes when the tax rate changes for 5 reasons. Okay, the first reason, so where does delta tax base, delta TAW come from? Well, 5 things. The first thing is the simply mechanical or direct effect. Well, actually, no, 4 things. Let me go back. The direct, no, there's 4 reasons why delta tax base, delta TAW is non-zero. The first we might call the gross income or Laffer effect. This is the sort of basis of supply side economics, the idea of chapter 21 and 22. That basically you tax people on their work, they'll work less. Basically, the idea of substitution effects dominate income effects. Tax people on their work, they work less. Tax people on the savings, they save less. Basically, the gross income effect or Laffer effect is just the basis of what we call supply side economics. The idea that if you tax an activity, people will do less of it. So those activities generate surplus, you're creating deadweight loss. Okay, so that's the first sort of standard one. But the key point is, when you go beyond chapter 21 and 22, you realize there's lots of other reasons why taxes affect the tax base. For example, a second reason is a reporting effect, which is that income can be reported in different forms. So for example, suppose your employer offers you a choice between a $5,000 raise and a health insurance benefit that is worth $3,000 and is not taxed. $5,000 raise, $3,000 health benefit. Well, if your tax rate is 25%, you'll choose the raise because that's worth $3,750. If your tax rate's 50%, you'll choose the health insurance. That's worth $3,000. So by raising the tax rate from 50, so at a 25% tax rate, we raised $1,250, right? Because you were earning $5,000 versus a $3,000 health benefit. Let's say you think it's worth $3,000. At a tax rate of 25%, our tax revenue is $1,250. What's our tax revenue when the rate goes up to 50%? 0, because you chose to go with health insurance instead. So it's a Laffer effect. By raising the tax rate, we lowered revenues. Okay, so that's another reason why the tax base for this negative d-tax base dTAW. Okay, a third reason is what we call the income exclusion effect. The income exclusion effect, which is not tax evasion, but tax avoidance. Things like giving to charity, having a bigger mortgage, all the various tax wedges that are created by the fact that some activities are taxed and some are not. When some activities are taxed and some are not, it creates a tax wedge. When you're tax wedge, that will lead to a reduction in the tax base. So when the tax rate goes up, I give more to charity. That lowers the tax base. The tax rate goes up, I have a bigger mortgage. That lowers the tax base. And then finally, we have the compliance effect, which is what we talked about at the start of this lecture. Which is as the tax rate goes up, people will cheat more. So we have a simple example of figure 25.4. So let's imagine that let's imagine that you have an income of $50,000 and a 10% tax rate. So figure 25.4 in the left-hand panel. That is, you make $45,000 on your job and $5,000 mowing lawns. The $45,000 in your job is reported to tax authorities, the $5,000 is not. So the government taxes you at 10%, so it makes $5,000 in revenues on your $50,000 of income. Now the government says, I want more money, I'm going to raise my tax rate to 20%. Well, you react in 4 ways. First of all, you don't work as hard at work. Through the supply side effect, substitution effects, dominant income effects, you don't work as hard, your wage income falls. Second of all, you say to your employer, you know what? Now I want health insurance. Give me $2,500 of health insurance instead of paying me $2,500 in wages. That creates a hole in the tax base. Third is you say, you know what? I wasn't so charitable before, but now that I have a 20% tax rate, I might as well give to charity. I'm going to give $2,500 to charity. That creates a hole in the tax base. Fourth is you stop reporting your lawn mowing. It wasn't worth cheating when cheating only saved you $500. Now cheating is going to save you $1,000. It's worth cheating. You put those together, and the tax base has shrunk from 50,000 to 35,000. So now, while the government has doubled taxes, tax revenues have only gone up by 40%. The government's doubled taxes from 10 to tax rates of 10 to 20%, but because the tax base has shrunk, tax revenues have only gone up by 40%. People see that example? That is essentially what Feldstein said we should measure, is what happens to the tax base as the tax rate goes up. And if that number is greater than 1, if the tax base shrinks more than 1 form for tax rate, then we're on the wrong side of the Laffer curve. Even if it's not greater than 1, that still says that that's the elasticity should go into our deadweight loss formulas. Our deadweight loss formulas should include that elasticity. And so the bigger is that elasticity, the more costly is taxation. The bigger the leak in the bucket from using tax as a tool of redistribution as that elasticity gets bigger. Okay, notice that elasticity is greater than 1. Literally, the bucket's more than leaky. Okay, literally, as it flips inside out, and I don't know what the analogy is to leaking more than 100%. Okay, but it's less than 1. It just means that's how leaky the bucket is, and that's a trade-off with our social welfare function. Okay, so what do we know about that? Well, there's been a lot since Feldstein's article. There's been a huge amount of research on this, some by myself, much more by other people. And the conclusions are fairly consistent. As areas of economic research go, this one's pretty consistent. The evidence is that the overall elasticity, this number, is about minus 0.4. That for every 10% increase in taxes, you raise about 6% more revenue. That is, you lose about 40% in a shrinking tax base. So it's not, in this example, you lost, this example, you elasticity to 0.6, right? Because you only raise 40% more revenue from doubling of the tax. So you still raise money, you're on the right side of the Laffer curve, but there's still a non-trivial inefficiency. A 10% increase in taxes only raises 6% more revenue because there's this negative offset of minus 0.4. Okay? So that implies a significant deadweight loss. Taxation is not free. As much as we liberals like to pretend it is, it's not. There's significant inefficiency from taxation. The second point is that all of the effect comes from these. Remember, it's not surprising. We told you that there's no effective labor supply. We told you we didn't even know what the effect of taxation on savings is. The bottom line is, with tax data, you can actually ask the tax rate goes up. How much is each of these parts? We can't ask about this part necessarily. You can look at this part versus these parts. You can say, how much does the gross income change versus how much does your taxable income change? And all the effects happening here. People aren't working less hard or saving less. They're just doing less. They're doing all these other activities that create holes in the tax code. Which naturally leads to the third conclusion, which is it's all wealthy people. That essentially the delta tax-based etat is close to 0 for middle class and poor people. But it's more like minus 0.6 or 0.7 for rich people. Okay. That really the elasticity of the tax the tax rate is much higher for the rich to the poor. Okay. This has very important implications. These two conclusions have very important implications. The first implication is, given the way our tax system goes, this is an extra cost of progressive taxation. Remember, I talked about progressive taxation. In my example of progressive taxation, I had an equal elasticity of the rich and the poor. And I still said the deadweight loss was higher from progressive taxation. Now I'm telling you the elasticity is even higher for the rich than the poor. So there's a really high deadweight loss from taxing the rich. Okay, this is the only time the Wall Street Journal has ever liked me, which is when I wrote an article claiming that we should have a flatter tax system because I found this discrepancy in elasticities. Okay, that basically it's really a kick in the teeth of progressive taxation. So that besides the general tau squared argument, this other thing, which the elasticities are higher at the top. Okay, so it's a real fundamental limit on how progressive taxes should be. That's point one. Point two is that this is not a fixed parameter. It's a parameter, it's a function of how the tax system is set up. And there's a really crucially important article by Wojciech Kupchak at Columbia. And Wojciech did is he re-estimated this number in different periods where there's more and less scope for these things. So for example, after 1986, there wasn't nearly as much scope for these things because we had a much more Hague-Simons tax system. In other words, there was more scope. And what he found was the broader and less hole-ridden, to be technical, you made the tax system, the lower the elasticity was. That is, the more you had a Hague-Simon, the more you moved to a pure Hague-Simon tax system, the more this number fell. Why? Because there wasn't scope to do anything else. If you just taxed on what you earn, and there's no deductions for charity, and there's no, in health insurance is tax like income and all that, what can you do? There's nothing to do. There's no way to evade taxes. This is crucially important because what it says is this is a stronger, that our argument, while I first said argument against progressive taxation is stronger, it's also true our argument for Hague-Simons is even stronger. Because the Hague-Simons system not only lowers the tau square effect, it lowers the elasticity part. A true Hague-Simons system, we can have a very high tax rate without a lot of inefficiency. Because a true Hague-Simons system, this would be the only margin people could respond, and that's a low margin of response. So what that says is this is a fundamental argument. If you put this together with the higher number here for the rich, it has a clear implication, which is we should have a broad, flatter tax system. We should have a tax system which is much broader, so there's less holes that people take advantage of through these margins, creating less deadweight loss, but probably flatter too. Now, you could tax the rich more, because remember, the rich don't respond this much among this margin. We probably should have a somewhat flatter, broader tax system. So that'd be sort of the economist case for why we like something like the Tax Reform Act of 1986, which it basically went to a broad tax base with 3 tax brackets. They're progressive, went 15, 28, 33, but it went from 50 to 33. It fell a lot at the top. And it collected the same revenue because it broadened the base so much. So it would lower the rate 50 to 33 without cutting revenues too much because we broadened the base so much. It was a classic Hague-Simons tax reform. So the question is, why don't we just do that again? I mean, every economist would favor it. It's like the Tax Reform Act 86 like economist porn. I mean, it's like we all, it was like exactly that's a bad analogy. Whatever, I don't know what the right analogy is. It's economists. What does everybody like? It's economist cupcakes. I don't know what it is. Anyway, it's kind of, why don't we just do it again? Okay, why don't we just? And the answer is that basically there's 2 fundamental pressures pushing against this kind of reform, which make it sort of amazing they got the 1986 reform done at all. Okay, there's 2 fundamental pressures pushing against it. The first is the political pressure, which is that basically when you create a broader, flatter tax system, some people lose. So for example, if you get rid of tax breaks, everyone who benefits from each of those tax breaks is going to lose, and they're going to lobby against it. Okay, so there's a political pressure against doing it. There's also political pressure to move away from Hague-Simons. And here the biggest culprit is President Bill Clinton. President Bill Clinton came into office with all these very ambitious things to do about investing in human capital and other things, and quickly realized Congress wouldn't approve if he called spending, but they would approve if he called them a tax break. So instead of saying I'm going to spend money in college, you should a tax break for going to college. Instead of spending money on state and local infrastructure, you should a tax break for state and localities to build infrastructure. Same fiscal cost. It's just somehow that got passed and spending didn't. So it's political pressures for complicating the tax system because that's a relatively painless way to spend money. And it's political pressures once those tax breaks are in place they're incredibly hard to get rid of. It's sort of a miracle Tax Reform Act of 86 happened. Actually, what happened was literally they sequestered a bunch of Republicans and Democrats at an Air Force base and didn't let them leave till they, I don't know who didn't let them leave. I mean, presumably they weren't jailed, but they sort of had a mutual agreement they weren't going to leave this Air Force base, so they had a bipartisan tax agreement. Okay. It's just incredibly hard to do that because there's pressures to make the tax system have a bunch of cute breaks in it. The description that was best is you can think of the tax system as a Christmas tree that gets more and more ornaments. Occasionally you shake all the ornaments off and then they start building the ornaments back on it. Okay. And economists would like to shake those ornaments off. And that just is tough politically. But it's not just tough politically, it's tough economically too. And this comes to a very interesting area, which touches a bit actually on finance, which is basically the problem of capitalization of tax breaks. Of tax breaks. And the topic of what we call tax shelters. A tax shelter is an activity which exists only to minimize taxes. Many activities, many investments, you make money and you try to do it to save taxes. A tax shelter is something which would not be economically viable, but for its tax minimization properties. That's what a tax shelter, okay? So for example, there's huge tax breaks for drilling for oil or for other things. And these are things which would not be profitable. And in the mid 1980s, these things actually got a bit out of control. So for example, the mid 1980s, there was a 60% deduction for capital gains, and there was a 60 to 80% immediate depreciation of oil and gas investments and other things. So basically, what you had is people investing in activities that essentially could create paper losses and save them on taxes. So look, for example, table 25.1. Imagine there was, this is in the early 1980s when the top tax rate was 50%. This before Tax Act of 86, top tax was 50%. So imagine you had an oil venture that you would invest $100,000 and sell in 1 year for $90,000. Well, that's a pretty terrible investment, right? You invest $100,000 now, you can sell next year for $90,000. We call that a bad investment. But in the early 1980s, it wasn't a bad investment because you could invest $100,000, you'd sell the oil venture for $9,000, you lose $10,000, but you would get a 60% deduction from this year's income for making the investment. That was a $60,000 tax savings. And you deduct the $10,000 in losses from next year's income. It's another $5,000 savings. So you actually made money by making this losing investment. That's what's a tax shelter. These tax shelters got kind of out of control. One oyster farmer recruited buyers of young oysters by claiming they could deduct the cost of the oysters up front, pay taxes on the income only 2 years later when the oysters matured, and treat that income as a capital gain. Eventually, the IRS disqualified it. But that was the kind of shenanigans that were going on. This is clearly inefficient. You're losing a lot of tax revenue. It's inequitable because only the rich do it, etc. So you want to get rid of these. The problem is people invested in these lose when you get rid of them. And they lose a lot because the value of that tax shelter has been capitalized in the price of assets. So for example, imagine there's 2 apartment buildings, okay? One apartment building is in a rich area. So it yields $2 million of rental income every year. The other apartment building is in a poor area. So it only yields $1 million of rental income every year. But there's a special tax break for people who build apartment buildings in poor areas of $1 million a year. Okay. So the first one, you get $2 million a year in rent. The second one, you get $1 million a year of rent plus $1 million a year in tax break. Because we want to, promote building apartment buildings in poor areas. Well, given that, the price of these 2 apartment buildings should be identical. They both yield $2 million. Now let's imagine we get rid of this tax break. I mean, they both yield $2 million, so they'll be, $2 million capitalized. So let's say this is at a 10% interest rate. They each sell for $20 million. Now let's say we get rid of this tax break. Well, the price of this apartment building the value probably just fell in half. This one's still worth 20 million, but this one's only worth 10 million now. That means by getting a tax break, we didn't just take away the $1 million a year this guy was getting. We took $10 million of his wealth and he did nothing wrong. This was the market price of the apartment building. He just paid it. And suddenly by this government's decision, his wealth has fallen in half. Okay. That is what's called a transitional inequity. That basically when people make investments based on a set of rules and you change those rules, you destroy asset value. This is true all the time. Imagine you have a house on a beach and the government says, no, this beach is environmentally damaging and we need to sort of, get rid of the seawall that keeps the beach intact and let the beach flood. Well, your house just disappeared in value. But it could be the right thing to do from a policy perspective, but certainly as homeowners are gonna be kind of pissed. Okay, they did nothing wrong. They bought it something which had a certain asset value, and because of some decision out of their control, suddenly asset values fell enormously. Okay, so this is an example of the problem of these transitional inequities. And this is an economic argument against tax reform. It's not just a political argument, it's an economic argument. It's a horizontal equity argument. Basically, when you reform taxes, you hurt people who basically made, at the time, optimal investment decisions. Yeah.
Shouldn't the risk of that happening be included?
Excellent question. In theory, you should say, well, tough shit, buddy. You should have known this could happen. And you shouldn't have paid $2 million for that apartment building. That is absolutely right. That's a great question. That should be incorporated, but it might not be. It might not be. No one saw the Tax Reform Act of '86 coming. So my parents, who are good, upper middle class, middle of the road people, they hated Tax Reform Act of '86 because they'd invested in a bunch of tax shelters because that was the thing upper middle class people did back then. And they didn't properly discount. No one thought they were going away. They've been around forever. Okay. So basically that in theory you should, but in practice it causes these giant transitional equities. What do you do about that? Well, the answer is basically you do what you need to do to get to the right place. In other words, if you say, look, the right policy, get rid of this tax break, but a bunch of people are going to lose money. There's two things you do. One is you could phase in. You basically, we're going to get rid of this $1 million, but we're going to do it very, very slowly over time. So that's the values kind of come down. They don't crash right away. The other is you can do what we call grandfathering, which you can say any building, that tax break will still exist for any building already built. We just won't give it for any new building. Now that's super inefficient because basically you're just giving away money. That has no marginal benefit, right? It's just inframarginal, you're just giving away money. But you can sort of almost view the money you give away as the price you pay to get the incentive right going forward. So think about any tax break as having two parts: all the embedded asset value that's based on that tax break and the improper incentives going forward. You think about giving back the embedded asset value as a price you pay politically to get rid of the improper incentives going forward. And that's the argument for grandfathering. Okay. You might think grandfathering is inefficient. Why are we giving these guys a break? Well, that's the argument. It sort of greases the wheels of getting the right thing done, of dealing with these transitional inequities. Okay. So let me stop there. We are going to come back next time and we'll talk about consumption taxation and moving to sort of a totally different kind of tax system. And then I'll talk some about the final, and we'll probably end a little early.
Don't forget to fill out your course evaluation.
Yes, course evaluation, please, thank you.